Now, as we look at the broader, so we're not looking at Jay Powell, we're not looking at Goldman Sachs, we're looking at the broader industry of analysts who are trying to forecast these things. This is looking at recession odds across a broad market of analysts and economists. And as we sit here right now, they're viewing this, the odds of recession in the next 12 months at 60%. So I would say that's a fairly stark contrast from where Jay Powell is saying no recession and Goldman Sachs is saying 20% of a recession. So this kind of leads us to the other side of the coin to say, well, why are we seeing such a divergence? Why are we seeing some analysts expecting a recession or forecasting a recession in the next 12 months? And again, making it very clear, these things are not guaranteed. All we can talk about is probabilities. So first things first, this is going all the way back to the late 1940s of data. So this is where I'm saying we're looking at some new charts that we haven't historically looked at. I'm trying to go as far back as we can to get as many instances of these occurrences as possible. What we're looking at here is the ISM Manufacturing Index. And what I've done is I've overlaid, and I've done this on all these slides, I've overlaid these red vertical sections, which are official recessions per the NBER. They're a little hard to see, but I can tell you over this time period, there's 16 of them. And over this time period, the ISM Manufacturing, anytime it's dipped at or below 46, it has signaled a recession 12 out of 16 times. So it's got about a 75% hit rate. So I asked my analyst, who's a big basketball player, I asked him to give me an example of a free throw shooter who shot 75%. So this is basically LeBron James. That's about how effective the ISM is in predicting or coinciding with a recession. And it is worth noting that last month, we got a small uptick this month, but last month we did see ISM at 46, right on the dot. Now, again, making it very clear, it is not a perfect indicator. It's 75% of the time. Could it miss? Absolutely. But as we sit here right now and looking back over the historical cycles, it looks like when data gets down into this range, it tends to coincide or precede a recession.
Yeah. Hitting 46 within the year, or does it happen like shortly thereafter? Or what?
Yeah, it would happen shortly thereafter, or it can happen simultaneously. We're just looking at where the data point is relative to these vertical red lines. And we're doing the same thing in the next couple. So the next one has a little longer history. We're going back to the early 1920s, so back almost Spanish flu time period. We're getting into the early stages of the Roaring 20s, and obviously in the 30s you had the Great Depression. But this instance has 22 instances of recession. Industrial production, which measures just the manufacturing, industrial output of an economy. We're looking at the data on a year-over-year basis. And anytime industrial production has dipped below 0%, so in other words, it shrank, anytime industrial production has gone below zero, 82% of the time, or 18 out of 22 times, it has coincided with or preceded a recession. So again, talking basketball terms, this is Kobe Bryant shooting free throws, little better than LeBron in terms of his free throw abilities. And as we sit here right now, we actually are in slight negative territory. So again, both the ISM and industrial production, they've only very, very slightly breached the thresholds that we're using in these probabilities, but they are in those territories right now. So again, this is a little better odds of either forecasting or coinciding with a recession 82% of the time. Flipping to the lending side of the equation, there's a recent data point that came out earlier this week. It's called the SLOOS report, which is the Savings and Loan Officer Opinion Survey. So the SLOOS, and what they do is it's similar to the ISM, but they're going out to loan officers all across the United States and saying, are you increasing your lending standards, or said a different way, are you lending more or are you lending less? Are you seeing things better? Are you seeing things worse? And if we look at commercial and industrial loans to medium and large size businesses, this is the number of respondents, or sorry, the percentage of respondents that are suggesting they are tightening standards versus loosening standards. So in other words, they're putting out less loans or being more stringent on loaning into these types of businesses. Anytime we've seen this survey tick above 50%, so in other words, more than half of the respondents are saying they are tightening lending conditions, it has either coincided with or preceded a recession. And I think it makes fundamental sense. If the central bank is hiking interest rates, and if loan officers are saying lend out less money, that at some point could or would be restrictive to an economy until or unless you have a society that just doesn't need debt anymore, which I suppose is a slight counteracting factor to this. There's been a lot of money printed. Maybe you've got more and more businesses that just don't need money. But this one's got a little less history, and I want to make that caveat. This is only going back to the early 1990s, which is as far back as the data can go. But again, you can see the distinct relationship between credit tightening and recessions. I've got two more, I promise. I'll stop being such a wet blanket. This one has not yet occurred, and it's a ways off from occurring. But this is looking at, and I know we've talked about this in the past, the 2-year Treasury yield versus the 10-year Treasury yield. And I'll give a quick background on what we're looking at here. 2-year Treasury yield versus the 10-year Treasury yield. In a normal market, 2-year yields are typically lower than a 10-year yield. And the reason for that is because if you're going to take 2 years of credit risk to a government versus 10 years of credit risk to a government, if you're going to take 10 years, you would expect to get paid more because you are taking a longer duration of counterparty risk to that entity. There's a higher likelihood that that government or that company could go bankrupt and not be able to pay you back. So in a normal market, a 10-year interest rate is typically higher than a 2-year interest rate. Well, we're in a phenomenon right now where that's not the case. And that's not the case because we're in a very quick rate hiking cycle. So the Fed funds rate, 2-year Treasury yields, all of the nearby interest rates are going up at a very, very fast clip, basically reflective of what Jay Powell is doing. Meanwhile, the 10-year Treasury is already attempting to look beyond this and say, well, at some point, they're going to have to stop hiking. At some point, inflation will get under control. And at some point, the Fed will actually bring interest rates back down into a more normalized range. And when that happens, when that phenomenon occurs of looking through the rate hike cycle and saying things will get back to normal, you get what's called a yield curve inversion, or in other words, this white line goes below zero. So we've talked about it in the past as being an early indicator of a recession. And historically, you can see that and pretty much any time the yield curve has gone below zero, it has been before. And when I say before, it can range anywhere from 8 months to 24 months on average. Every time can be different. Every time is different. But what's interesting is it's actually when the yield curve goes back into positive territory, or said a different way, uninverts. It's really when it uninverts that we've got the issues. We're still sitting all the way down at negative 71 basis points. So we're ways away from anything inverting, which means that recession that we've been kicking around is not yet here. Now, I would probably take a step back and say, as I said at the beginning of this slide, the normal state for the yield curve is positive, meaning it would be 2-year Treasury yield is lower than the 10-year Treasury yield. So in my opinion, it's a matter of time until this shape of the yield curve goes back into more of a normalized state, and that may coincide with some sort of recession. But we don't know if that's going to be 3 months, 6 months, 12 months. But what we can use is probabilities, and using the historical instances where it's happened in the last 6 times, it has precluded, the inversion has precluded the recession by about 12 to 24 months. And I apologize, my dog just found the perfect time to play with her bone. Last but not least, and this one has 100% accuracy and a whole lot of data. And I think it makes sense why it has 100% accuracy, because this is probably the best gauge of whether or not an economy is in recession. And the good news here, and I want to make sure this is seen as good news, the good news is the employment picture in the United States is still extremely positive and does not really show any immediate signs of abating. But if we do entertain this idea for a second, and we consider the idea that in order to have a recession, 100% of the time, the unemployment rate has had to increase by at least 150 basis points, or 1.5%. We're sitting right now at 3.5%. And as you can see on a historical basis, that's extremely low. We have a very tight labor market still, even with all of the job losses that have occurred mostly out of Silicon Valley and some of the financial sector. So we have seen very, very little loosening of the unemployment rate at this stage. So if you're trying to prepare, because that's really the point. None of these slides are meant to scare anybody on this call. They're meant to act as a preparedness factor for Ryerson and for our customers to try and make the most sound decisions on economic conditions. And this one is not flashing red lights at this point. We're going to keep an eye on it. And certainly if we see unemployment tick above 4%, we're going to have a much more keen eye on the employment picture, because that seems like the most sound instance of really precluding or being intertwined with a recession. So a little bit of good news there, which is the employment picture looks very, very strong. The yield curve is still showing no signs of uninverting. So there are a couple bright spots in what looks like otherwise what Jamie Dimon recently called storm clouds that could be out on the horizon.
So to recap out of those five, right? So you had PMI, industrial, lending standards, yield curve, unemployment rates. We're currently have hit three of those: PMI, industrial, and lending standards, but we have not hit the yield curve and unemployment.
That's right. That's right.
Would it be fair to say that since the last three, so unemployment rate, yield, and lending, 100%, right? We've only hit one of those. That would be fair to say that maybe they're right about no recession. I don't want to put you in front, but like saying that like the ones that hit 100% of the time, albeit short, small.
Yeah, I mean, I think that's an optimistic way to look at it, but I think it's also an accurate way to look at it. Talking the other side of the equation, I showed 5 charts. 3 out of the 5 were showing a recession at some point in the near future. 3 out of 5 is 60%. If you remember back, the recession odds right now are sitting at 60%. That could be essentially the art that they're using to compile that index. But yeah, you're exactly right. The 2 that are the best predictors, the ones hitting the perfect game, are the ones that are still not flashing red lights at this point.
Yeah, great data. No, that's a great look at those. That's really good.
And the one other caveat that I don't want to belittle is the idea that yes, the manufacturing economy is in what looks like a soft territory, but it's worth noting, worth keeping in mind, the manufacturing economy is still 20 to 25% of the U.S. economy. So if services remain strong, balance sheets of the individual consumer remain strong, this party can keep going on the way it's going. I mean, I don't think it's a bad idea to remember the fact that we printed several $1 trillion in the last couple of years, and there are much stronger balance sheets at the individual level than we've seen in a long, long time. So it may be the case that what's happened in the last couple of years has changed the equation a bit. Now, some of them I think have very obvious ramifications on the economy. If every loan officer and their brother is tightening lending standards, yeah, at some point that's going to tighten up market conditions. We just aren't seeing it just yet. And last but not least, this is the forecast into where market makers, traders, analysts are thinking rates are going to go. So as we sit here right now, the market is essentially saying Jay Powell's done. They aren't saying it's time for cuts just yet, but as we sit here right now, 5.5% on the Fed funds rate. It's been a big journey to get here. We've raised interest rates by 500 basis points. It looks like they're going to stay here at, I would say, best case scenario, until or unless one of two things happens. Either one, they are very confident that they've won the inflation fight and they can do no wrong by lowering interest rates, and that's not going to reignite some secondary inflation wave. Or the other thing would be an actual economic distressful situation like a recession. Until or unless one of those two things happens, it looks like they're probably going to keep rates flat at best. There's an expectation that something, whether that's inflation coming down further by early 2024 or recession by then, there's an expectation that for whatever reason they think Jay Powell is going to be able to be cutting interest rates come 2024. We'll have to wait and see. This graph is certain, these probabilities have certainly been wrong for a number of periods leading up to this point. But it's a snapshot as of today.